Hi, this is Michael O'Leary from Buy the Book Taxes, back with the last in a series of video blogs discussing payroll tax liabilities. This video blog is going to discuss the strategies for resolving the payroll tax liabilities. Okay, there's really two strategies. The first, let's say you are the chief financial officer or an executive vice president of a company, and the IRS is coming after you saying that you're personally liable for these payroll taxes. The owners have disappeared, and now they're looking to collect from you. The first argument you have to try and make is to say, I'm not the responsible party here. I may have a fancy title, but preparing, filing the payroll tax returns, signing the checks, hiring and firing employees, that wasn't my responsibility. I am not a responsible person. Those are the key points, as you can see the bullets here. That way, they don't come after you, they go after the business. Okay, so let's say the IRS is not going to be successful going after individual employees, they have to go after the business. What are the business's options to solve these tax liabilities? They are the same options that are available to individuals to resolve their own personal tax liabilities, which are setting up an installment payment agreement, getting declared to be currently not collectible, or filing an offer in compromise. Same options available to individuals. Okay, there's three different types of installment payment agreements: streamlined, regular, and partial pay. Streamlined means you have the ability to pay the debt in full. It's under certain limits so that a financial statement is not required. Here are those limits. If it's a business that owes less than $25,000 and can pay it back over 24 months, they don't need a financial statement from the company, just a form signed with banking information so they could set up an electronic debit. If an individual is liable, there are two different types of streamlined agreements depending on how much you owe and who's doing the collecting. If it's the IRS field office, you can set one up with a maximum of 72 months if the amount is less than $50,000, $50,000 or less. If automated collections is collecting the money, you can go as high as 100,000 and pay it off over 7 years, which is 84 months. Why these two different groups within the IRS have two different tolerances and two different time frames, I'm not sure. Okay. So a regular installment agreement is one where the amount that is owed is above those threshold limits you saw on the prior slide. So the IRS is going to require a financial statement so that they can determine how much the business or the individual can pay back on a monthly basis. A partial pay installment agreement is one where the individual or the business will not be able to pay back the liabilities in full before the 10-year statutory period that the IRS has to collect the debt expires. In the case of a partial pay installment, the IRS will require a financial statement, and they will check back in with either the business or the individual every 18 to 24 months just to see if their financial situation improved, which would allow them to increase their monthly payments. Okay, another option is currently not collectible, CNC, which means that after looking at the financial situation of the business or the individual, there's not enough money left after taking into account business expenses or living expenses to be able to pay the IRS back. Doing so would create a hardship. The IRS wants to collect money, but they're not looking to create hardship for anybody. So you could get put on a currently not collectible status, and that will be revisited in about every 2 years. The last option is called the offer in compromise, where you make an offer to the IRS, either the business or the individual, to settle the debt for less than the full amount owed. Two different types of offer in compromise. Lump sum, which requires a 20% deposit of the offer amount, plus an application fee. Typically, it takes 6 to 8 months to have an offer either accepted or rejected. If it's accepted, you must pay the remaining balance within 5 months. A deferred offer has no deposit required, but still has an application fee. Another difference is you must make monthly payments to the IRS while the offer is being considered. And once it's accepted, you have 24 months to pay off the balance. This is a good option if you don't have the cash to make the required down payment. It's also a good option if the offer amount is based on the assets that you own as opposed to your income. You might, I've put out other blogs. You might go to my website or YouTube page to look for the blogs where I talk about the offer and compromise calculations. A lump sum is better when it's based on your income because they're only looking at 12 months of income, whereas with the deferred, they'd be looking at 24 months. So you'd be paying twice as much on a deferred if it's income-based. That's why the deferred is better when it's based on the value of your assets, because the offer is the same, but you have 24 months to pay it off. Okay. If you're a business owner and you have payroll tax liabilities, if you work for a company at a executive level and you could be responsible for delinquent payroll taxes, you should give me a call. If you have years of unfiled tax returns, or you haven't paid your taxes in years, please call me. I can help.